Hello, greetings. Welcome to Dividend Blasters. This is our 95th video. Topic today, sold all of my Jepi. That's right, every last share. Why have I done that? Because there's some newer, better performing covered call ETFs out there. I'm going to get better return for my dollar. I'm going to talk about them. I'm going to talk about one in particular, GPIX by Goldman Sachs. All right, let's move on. First, a disclaimer. I'm not your advisor. What I tell you is not financial advice. This video is for information and education. It reflects my own opinions, research, and experience as an independent investor for more than 30 years. Do your own research, do your own due diligence before buying any new stocks or ETFs. So, what am I going to do? I'm going to talk about two metrics in particular. I'm going to talk about price return and I'm going to talk about total return. And I'm going to do it over two different time horizons, year to date and 3 years. And I'm going to compare GPIX with Jepi and SPYI. All right. So, price return year to date, and this is just price appreciation in the market. GPIX has achieved 2.67%. Meanwhile, Jepi is below zero, minus 0.63%. SPYI by Neos Investments, 0.59%, an eyelash above zero. And none of them are returning what the S&P 500 is. So if you invest in SPY or VOO, or IVV or any of the other S&P 500 index fund ETFs, you will do better. But it really here is a matter of preference. Why do people invest in covered call ETFs? They're doing it for the income, and it's really a matter of personal preference. People are in different phases of their work life or their life, and they need the income and they need the dividends. So, and I'm going to talk a little bit more about why sell covered calls, why invest in covered calls. I'm going to do that a little bit later. So, anyway, that's price return year to date, price return over a 3-year time horizon. What you see here is GPIX really separating itself from Jepi even more, and from SPYI. GPIX 29.33%. Jepi still below zero, minus 0.28%. SPYI 4.06%. They're all pale in comparison to the S&P 500, a little under 57%. So I want you to hold that thought and think about that and say, hey, why is that? Why is that happening? All right, total return. And why am I covering total return? Total return is actually very important to cover when you are comparing covered call ETFs. And if you're comparing a covered call ETF to a regular ETF that doesn't have an options overlay strategy, you really need to do that to kind of equalize things. And that way you can compare apples to apples. You can basically say, yeah, this is the return I'm getting for investing, because you're getting price appreciation or price return, and you're getting dividend income. And so it's the both of those that basically get you your total return. So let's do a comparison. Total return year to date, GPIX 7.88%, outpacing significantly Jepi, which is 3.82%. SPYI has outpaced GPIX here, 7.98%. Total return year to date. So they've closed the gap. You're going to see the reason they've been able to do that is they have a higher dividend yield. But dividends is only part of it. You really, really don't want to cap your upside. And what does that mean? You want to take advantage of a great bull market. You want to get price appreciation. And especially for the younger investors, you have a longer time horizon ahead of you while you're working, you're saving, you're investing, you're building your nest egg. I think it's great to invest in covered call ETFs when you're younger, but my opinion, and this is not advice, is to go long and hard into the index funds. Get that growth from capital appreciation. Invest in the market. Invest in great stocks. that can grow significantly, and then gradually build your dividend holdings, your dividend portfolio. And then as you get older and you get closer to retirement, you start to accelerate that way more. Because here, take a look at this. Look at the total return for SPYI and GPIX next to the S&P 500. It's close. Okay, so you have to look at total return when you're looking at a covered call ETF. Looking at price return for these is only part of the story. The major takeaway for this slide here is that both are absolutely killing Jepi, which is 3.82%. So this is a big deal because this is your money. And money does not grow on trees, as you know. All right, total return 3 years. You know what? I'm using 3 years again because GPIX and SPYI are very young. They're not older than 3 years old. Jepi's a little more than 5 years, so I'm trying to get it close. So GPIX 3-year total return 49%. It's close. I mean, it's about 7 percentage points below the S&P 500. It's not there, but it's close. But again, if you invest in a covered call ETF, there's a reason. There's a personal preference. Looking more closely at the other two covered call ETFs, Jepi's about 20 points behind GPIX. What the heck is going on? Wow. SPYI is darn close, 48%. So it's really right there with GPIX, but GPIX just kind of edging it out a little bit. So before we take a closer look at these side by side and look at these, kind of sum up these metrics, just here's a little bit of more high level information. And look at the assets under management. Jepi has been around longer. They dwarf the other two, 41.29 billion, SPYI 4.5 billion. So it's about 10 times the size of SPYI, about 20 times. I'm sorry, 30, 40 times the size of GPIX, because these are much newer. But you know, to me, the major takeaway here is not just the size of the assets that they have, that they manage, it's the expense ratio. So take a look at Jepi's 0.35% or 35 basis points. So remember, every $10,000 you invest, you pay 35 bucks a year in a management fee. And these are actively managed ETFs. And how are they? They're selling covered calls. They're selling call options to generate premium income and to turn that some of those premiums over to you in addition to any dividends that they earn from their holdings. So that takes a lot of work. They got to pick a strike price. They got to manage the option and collect the premium, and hopefully, they're successful. SPYI's expense ratio is almost double, 68 basis points. 35 is not bad. I love GPIX's 29. SPYI is a little bit more, So anyway, I like it cheaper. So let's move on a little bit. And here we are side by side. Some of the same information here. But what I'm doing is I'm racking and stacking some of the key metrics. And I'm putting a green check next to which one is the best for a particular category. Expense ratio, GPIX. Assets under management. Well, that's no surprise. It's Jepi. They're so big. Dividend yield, I skipped that one. Dividend yield for the trending 12 months, it's NEOS, SPYI, 12.04%. And I can explain a little bit why they can, the distribution, it's a distribution really, because it's not just dividend, it's premiums that they're generating. So it's distribution. Why is it so much more? Why can it be so much more than the other two? Okay, so I talked about assets under management. Price return year to date, it's GPIX, 2.67%. It's absolutely crushing the other two. Total return year to date. Well, here we go. NEOS is a little bit edging out GPIX. Price return 3 years, no contest, GPIX. Total return 3 years, it's closer, but it's really no contest with Jepi. Jepi's getting killed. GPIX 49%. SPYI is very close, 48%. This slide tells you a lot if you look into this. Why is the total return so much more than Jepi's? Why is it more than SPYI's for 3 years, but it's a little bit less than year to date? Think about that and hold those thoughts, okay? Because I'm going to get into it, and this really relates to a couple things. I'd say first and foremost, it's the covered call strategy. So GPIX has what we call a flexible or a dynamic covered call strategy. So when they're writing calls, they're basically varying the percentage of holdings they're going to put up on a covered call. It can be anywhere from 25% to 75%. And I will tell you that when you're in a bull market, you want to sell fewer covered calls. Okay? You also want to sell further out of the money. And why do you do that? You want to capture the upside. You sell further out of the money because you don't want your option to be assigned, you have the shares called away, and you have to sell them at your strike price, which is probably a good strike price, hopefully. But if they're going to get called away, the market still keeps going and you've missed that upside. And so they're probably selling fewer of those too. So that's one thing. 25% versus like 75%. And SPYI is in that higher range. And that's why they're able to offer that higher distribution, the 12% versus the 8% for GPIX. What is the net result of that? Well, you know what? They have holdings that they're not selling options on, and they're going to just appreciate because we're in a bull market. So they're taking a holistic approach to how they do this. So it's fascinating. There's a lot of strategy involved in this. So it's the flexibility. That's so important. What else? So the flexibility, the range of how much you're putting up there, but also something we call the moneyness. So when I talk about the moneyness, I'm looking at the market price of a security and I'm going to sell an option against it, call option. The moneyness is basically I want to try to sell, if I'm in a bull market, I want to sell further out of the money, okay? Because I do not want my shares called away. I don't want the option assigned. I want to keep the shares. I want to keep the premium that I've made from selling the options. I want to keep those shares and do it again. And I want to keep doing this so I can keep generating more premium income. That's what these guys are doing. That's what they should be doing. So GPIX is doing that. And that's why they have a dynamic options selling strategy. And in the bull run market, they're not going to sell 75% options against not going to sell they're not going to do options contracts against 75% of their holdings. They're going to do it probably closer to 25%, as I said, and out of the money. They're going to sell them way out of the money, and so they're going to capture the most upside. SPYI sells out of the money, covered calls, but they have a higher concentration of their holdings that they're putting up there. So there's a greater probability of options being assigned and shares being called away. So you know what? They're going to get a moderate yield. The total return is not going to be as great. It's going to be close because they offer a higher, if they're going to get higher premiums from the options they generate, but those shares are going to get called away. So that's the trade-off. Okay, so higher distribution, but less upside. They're capping their upside. Jepi, they sell a little bit closer, to the market price, and there's going to be a modest upside, as we have seen. You don't see a lot of price appreciation with Jepi. And you're not even getting that yield. Now, 3-4 years ago, they were revolutionary, but the game has changed. And right now, I'd say SPYI is a better covered call ETF than Jepi. That's my opinion, but also in my opinion, GPIX is better than SPYI. And I like SPYI. I own several shares of SPYI, but I have more of GPIX. What's the last reason? And I'm keeping this high level because I want this to be quick. The expense ratio, we covered that. GPIX expense ratio is the cheapest, 29 basis points. It's cheaper than Jepi's 35, and it is less than half of SPYI's, which is 68. You know, the higher, it doesn't sound like much. Well, it's 68 bucks for every 10,000 or 29. If you got several hundred thousands of dollars invested and you're retired, you don't want your holdings being consumed by management fees. And so that's another key thing. It's not the most important thing here. The options selling strategy is, but this is also important. All right, folks, that is it. Before I wrap up, just a friendly reminder: as an affiliate partner of Seeking Alpha, I can offer discounts for the best online digital investors subscription on the market, Seeking Alpha. So I am offering you discounts and a free trial period. So for the premium, $30 off and a 7-day free trial period. Alpha Picks, 50 off. Bundle, which is both, 159 off. I'm offering you the link. You can go there. You can also take a picture of the QR code and go right to the site and look at the offer. And I've summarized some of the key nuggets right here for premium and Alpha Picks. And you know what? I am a subscriber to both. I've been a subscriber to both for years. I love Alpha Picks. I'm going to get 2 great stock picks every month. They absolutely are killing the S&P 500. And what I like about premium is I am getting great insight and analysis to every single stock or ETF you can imagine. And as a serious investor, I rely on Seeking Alpha. The QR codes again and the links are below. And then also, if you want to look me up, I'm on other platforms, X, Instagram, and Facebook. I hope you found this video to be useful, informative, and enjoyable. If you did, give us a like, share the video with a friend, and we'd love you to subscribe to Dividend Blasters. Until our next day video, have a wonderful day. God bless.